Gold is known to be the safe haven asset. Copper is known to have a PhD in economics. The copper to gold ratio may be signaling that we are headed towards a recession in our near future. We're going to dive into that on today's Stock Market Brief Show. Make sure to hit that thumbs up if you haven't done so already. And today, instead of dropping a smiley face, which I'm okay with, drop the flag that represents where you are watching from. All right, let's get to today's show. All right, people, welcome back. So we're taking a look at gold here. It's a chart of the continuous contract. This is interesting because it's not getting that much attention, in my opinion. And just the other day, we hit a new high for 2024. In fact, the other day, we hit a new all-time high in the price of gold as it's been breaking out of this contraction pattern and heading higher. On the flip side to that, copper, which is known to have that PhD in economics, has been coming off after a monster breakout to the upside. We put in a high, a low, and we just cracked to another lower low. So are we starting to trend down in the price of copper? So when I pull up the copper to gold ratio, this means that when the line goes down, gold is outperforming copper. On the flip side to that, if it's going up, it means that copper is actually outperforming gold. And what I have here that I put together is a chart of the copper to gold ratio line dating back to the 80s. And in the gray shaded areas, you see when we've had recessions. And I wanted to call out that many times where you see this line drop, we're actually near and around a recession. It doesn't mean all the time, but you can see in the 1980s, we dropped pretty significantly right here during the recession. Here we saw a pretty big pullback right here in 2000s in the financial crisis. Even here into 2020, we saw that big drop. And what we're seeing now is the copper to gold ratio heading lower in this current environment. And that's because gold is outperforming, obviously, copper coming in. So is this signaling a potential recession? Well, I wanted to take it a step further and share the yield curve, because a lot of people have been talking about the yield curve, but also saying it doesn't matter this time, which it hasn't been proven to not matter yet. So if we take a look at the 10-year, 2-year yield curve, what you'll notice here is the gray areas is still the shaded recessions. But what happens that I've noted in recent times, it's when you uninvert, it's shortly thereafter you see the recession take place. Here is pretty choppy and hard to understand, a lot of back and forth, but here is a lot more clearer in the 90s, in the 2000s, and then the 2006-07 area when we started to uninvert. And I'm bringing this up now, even right here, when we uninverted shortly thereafter, there was a recession. Now, we haven't fully uninverted yet as it stands, but there will come a time where the yield curve uninverts. And does that signal that in the near future, we may see a potential recession? Also to note, the federal funds rate. We're going through a period where people want rates to be cut. In fact, the Fed is looking for basically any reason now to start cutting rates. So much so that the probabilities, if you look at Fed fund futures, we're having about a almost 95% probability they're going to start to cut in September, and they're already pricing in more rate cuts for this specific year. Here in July, we have a July 31st meeting. There's about a 100% probability, not quite, but almost, that we're going to be keeping rates where they currently are. But what you'll notice here is we actually enter in the recessions during a time when we started to cut rates, and then we started to cut them deeper. We started to cut rates, boom, a recession hit, and we cut rates even further down. So this all kind of lines up with the theory of if we start to uninvert, well, the copper to gold ratio is signaling something right here as it's heading down, and we're about to go through a rate cutting cycle, potentially. Now, the main goal for the Fed is to get inflation down to 2%, but they don't want to wait for inflation to come down to 2%. Now, inflation has been coming off from its high. This was the United States core inflation. But if you do look back to the left of the screen, we're still as high, like the highest we've been, since the 90s, right? So it has been coming off, but it still remains high. Another thing that they look at is obviously the unemployment rate. And something interesting here is it actually ticked above that 4%. It's at 4.1 since June of 2024. And as this starts to go up, you can see we actually enter into recessions when these start to obviously uptick. Makes sense. And then you get spikes when you're in the actual recessions. Now, if we stack them all together and we look at something like the 10-year, 3-month yield curve and the federal funds rate, it's very common to see the market hit all-time highs and new highs when we have a yield curve that's uninverted while we're in a rate hiking cycle. And even when it pauses, it's when we uninvert and we start cutting rates is when we start to see turbulence in the market. So to say that it doesn't matter this time, well, we don't know if it's not going to matter or not because we actually haven't uninverted, we haven't brought rates down yet, and we haven't seen or given time to see how the market wants to respond to all of this. Now, we have been seeing weakness in the market these last 2 days out of every day pretty much this year. And this is due to most likely around this seasonal weakness period where things start to level out, flatten out, neutralize, go sideways, pull in, and so forth. And, I knew this going into the middle of June. So we put a video over here called The Great Stall of 2024 on, I think it was like June 26th, right around there. And you could see price made it up and everyone's like, oh, see, price, it'll never stop. Well, in 2 days, basically, in 2 trading days, we're back to these levels. That's how fast these markets can respond and react. Huge move up, couple of days to the downside, boom, gone. You got to be very careful in these environments. Now, that doesn't mean it's going to be crashing here by any means. I think we can be prepared and well-known, and I'll get into the market conditions and key levels because I actually think that we can potentially see a bounce here very soon. So I want to look at the volume, the VIX, which is the volatility index for the S&P 500. And one thing that we called out was not too long ago, the Bollinger Bands on the daily time frame, they got very tight. And for those that watch this channel, one of the main principles of technical analysis is that assets move between a contraction and then expansion. And they do that time and time again. One way to look at this is the Bollinger Bands, right? We got very, very tight. We haven't seen the Bollinger Bands this tight on a daily since really the lowest since going into the early 2027. And what I found interesting here, which is not predictive by any means, but I did find it interesting that if you stack them two up on each other, we're about the same period. Like we got this tight in around March. Here is February and March when we got that tight, but that was in 2007. And then what happens is we saw a pop in volatility recently. Right over here, we saw a pop in volatility. Sorry, that was the Bollinger Band. Pop in volatility right here. Pop in volatility right here. This indicator below in the red with the red is the Bollinger Band width. Okay, so that tells us when it goes down, it means the Bollinger Bands are getting tighter, is what that's displaying. Sorry. Okay, but then what I found interesting, after we saw that pop from being tight, what happened is it came back in and kind of consolidated, and then very, recently, shortly thereafter, in the month of July, you saw a spike up in the VIX, okay? And then what are we seeing here? We're starting to see that very spike in the VIX take place. Now, if you go back to 27, right, we saw a spike this time, and it went all the way up to around 30 or 35. I don't know if that's going to be the case where we come to 30, 35, but we are seeing a very similar type pattern, how we saw the spike, and then it started coming back down. It wasn't until later where we really started to see volatility, where we started to come back down, and then we started seeing more volatility later there into the future. And what I find interesting here too is not only does this structure look the same, but we're also at that yield curve that's uninverted. We started cutting rates. There's a lot of similarities here, which is eerie. And, one of the Mark Twain's quotes is, history doesn't repeat itself, but it often rhymes. And holy moly, this is pretty crazy stuff in my opinion. Once again, not actionable data, but still cool nevertheless. Now, I want to take a look at the CPC. This is the options total put call ratio. That's actually in purple. The purple line is behind us. Its opacity's turned down. I apply a 10-period moving average, and I have some couple levels on my screen, one of which is this red line. And the red line is when, this is interesting because we haven't actually been down to this red line since really going into 2022, okay? And what is considered a sell signal here that we've seen in the past is when it crosses under it, but then turns back up through it. So I highlighted the times when we ran through that period. Now, a buy signal is when we get above the blue line and then back down through the green, okay? You can see here in 2020, we saw this cross through. We saw a little volatility to the downside, came back up. We had another cross and we ran into the pandemic. Over here, now remember, the Fed stepped in, so it can look like, whoa, it kept on going up. True, but also pay attention to what happened when we crossed back up through it. We actually saw quite a bit of volatility here, quite a bit of volatility here back and forth. We saw a pretty significant size dip here. Even right here, saw some volatility. And then obviously going into 2022, the bear market as well. And then we saw a couple of times where it crosses above the blue line. We see it cross down through the green line, right? We see pops up to the upside, it crossed down through the green. We saw a pop up to the upside, cross down through the green, came still down, right? Right here through the green, up through the blue, down through the green. We saw a little move up. And then even right here, right? start to see it move up higher, and we haven't really had a sell signal since that point. So I just wanted to call this out. This isn't updated for today. I don't know where it's going to be at once this chart updates, but if we do start crossing down through there, I think we can at least know that if it crosses back up, we'll bring this back up and say, okay, based off of what's happened in the past when this happens, we can see if some volatility kind of erupt in the markets. Now, if we take a look at the gamma levels, the main thing I want to call out here is we're below the flip line. When you're below the flip line, which we talked about on yesterday's video, if we start getting below it, watch out because there can be some downside. It'd be bullish above it, bearish below it. Now, that's not always the case, but this is where, volatility increases, liquidity dries up, right? So you can get some wild swings. And today we saw wild swing to the downside, shot to the upside, wild swing back to the downside, wild shot right back to the upside. This is where selling begets selling, buying begets buying. We'll see where this updates come tomorrow, the new gamma flip line, but as it stands right now, we're under it, and that's at 55.80. On top of that, we're below the 5-day moving average. So this is indeed where I say that market conditions have significantly changed. So be careful playing breakout stocks, stocks that break out and so forth. Make sure your position sizing is going to be able to withstand volatility, because many times from what I notice when I trade, is I see a lot more false breakouts or breakdowns and then snap back up when we're in these current conditions. So this is the time to obviously be more cautious. We'll touch back on the SPY chart momentarily. Now, going into tomorrow's trading session, I'm going to share this with you again today. I usually just share this with the Discord group that I have, which is a link in the pinned comment. But these are the expected moves. And let me just once again say just how wild these are. It is an option expiration, but we have a $43 expected move in the SPX. That is large expected move. Look at the Qs. Expected move is $6.21. Yesterday we talked about this. It was $5.75. Okay, $6.21 is pretty much one of the largest ones I've seen. I'd have to go back and look because I can't remember, but I went back decently far, and I have not seen that for, maybe earnings last season. Maybe we saw some numbers up in that range. I'd have to go check, but $6.21. And mind you, yesterday's was $5.75. And we basically tagged the lower expected move of that. Okay. So we can potentially move another $6, tomorrow in the cubes. Wild to think that. Just wild price action. Now, I did find this interesting. I posted it on Twitter. Intraday on the 15-minute time frame, the SPY, right? The NASDAQ typically leads the SPY, right? Why? Because, the SPY is cap-weighted and the Qs have the largest cap-weighted names in there, okay? So the Qs, they started falling, right? They started putting in lower highs, which we said, be careful. It's a warning sign. The SPY kept on going higher because we started getting some more positive breath. But then the Qs followed through to the downside, and then shortly thereafter, boom, we fell. Now, the Qs, as it stands in this current moment, which I don't think that this is updated. I think it actually has more of a matching low, so right around in these areas. Maybe undercut it a little bit. I'd have to get the updated chart. Do I have the updated chart? Maybe I do. So the SPYs was making new lows for the trading session, so it did get to new lows, and then the Qs pretty much had matching lows here. And the reason why I'm calling this out is because if the Qs do technically lead the SPY, and the Qs find it within them and I think that they did bounce here. I'll pull up the 15-minute chart here momentarily. But if the Qs do hold up here, and this could be a signal that, hey, if we start bouncing here with the Qs, the SPY will then shortly there follow after. So I think that this little divergence could be giving us a little bit of insight. Another thing to look at here that I like to look at is the 10-period rate of change between small cap growth and value. And when it crosses under the zero line, it's a sign to be very cautious, right? Many times we've called this out where it crosses down below zero, it consolidates or pulls back, cross below zero, right? We pulled back significantly. And then I also like to look at pretty extended moves in the rate of change. For example, we talked about this negative divergence here taking place as the Qs continue to press higher, and this did play itself out to the downside. I'm calling this out now is because that is an extended reading on on this ratio from a rate of change perspective. The last time we had this was down here. We saw volatility, but we also saw moves back to the upside in this growth to value. So perhaps if you're very tactical here, I'd be looking at for a bounce maybe in the very near future, potentially even tomorrow, right? Or into next week in some growth names. But you got to be careful. Why? Because we're below a 5-day moving average and we're in negative gamma territory. So you got to take that into consideration when you are trading. Okay, let's take a look at the Qs right now. Okay, so this is the updated. So it did crack another low, so I guess the divergence isn't there, but let's be real. This is pretty much matching lows right there in the midst of high volatility, and the SPY definitely cracked a lot lower, okay? And then you could see we actually kind of try to clear this, making it somewhat of a double bottom. And you could see also we have a positive divergence there. As it stands in this current moment, the 5-day moving average is declining. We're below the week-to-day anchored volume weighted average price. The upper daily expected move looking into tomorrow's trading session is 485.70. Okay, the lower expected move, which is not on the screen, is 476.02. So if we're right, if we bounce back up to here, which there is a higher probability because that's where the weekly expected move is, just be aware in this area that the week-to-day would probably come down, the 5-day might come down, and we may get stuck in and around this range on a potential bounce. But that is what I'd be looking for going into tomorrow. I'm not interested really in shorting under here as it stands. If anything, I'd be more tactical and I just let it play out until we're back above a 5-day moving average and it starts to turn back around. So that would be the cues. In the IWM, when we started seeing the monster rally up, we said that there'd be a high probability that we can see it come right back down into and around the quarter date expected move, and we're there, and we're also back to the weekly expected move. Going into tomorrow, we have a pretty large daily expected move too. 214.85 is the low, 221.05 is the high. If you want these levels, you can just screenshot this and then put them on your chart, okay? So we're below a 5-day moving average here too as well, seeing a lot of volatility, even more around the corner. It's a $3 plus expected move again, but we do have a rising 5-day moving average here. So it's bearish, but with caution because these things can snap back too as well. So far, I kind of like the look of tech for the potential bounce as it stands in this moment. And this S&P 500 on the weekly time frame, guess where we pulled into? We pulled into the weekly weekly 5 EMA, which is at 5522 on the SPX, and we found ourselves a little bit of a bounce from that level. So far as it stands, we have an outside trading week, which can be bearish if we close the week like this, which it'll still be an outside trading week regardless because the high is here, the low is here so far. But if we start bouncing back up, it might give us a little bit different of a look, and we'll navigate it once we see that. And then the SPY on the 15-minute time frame. The SPY, you can clearly see, did make a pretty significant lower low today, and then we bounced right back up to the weekly expected move. If you manage to see the live stream, we talked about how it's very common. If you undercut it, you can come right back into the weekly expected move, and it's always likely to come back in, and you could just trade around it. That's pretty much what we did for the day today. We broke the month-to-date TWAP, right? The swing low. We broke it. We said, be careful there because that means the average person based off of that time and volume is now underwater and how that psychology can change. And we broke it. Bam, we flushed right into the week to date expected move. And we kind of just chopped in and around those areas. Going into tomorrow, the upper daily expected move, 557 and 8 cents, 548.24 to the downside. So as it stands in this current moment, I think that there's an opportunity to see a potential bounce. However, that doesn't mean that the trend has changed. So if you're being tactical, that's one thing. If you're hoping and praying, that's another. Okay, the Qs, as we stated, has put in lower lows and lower highs. So it's not going to change that until, obviously, we put in a higher high and a higher low. Okay, that's what I got for you on today's episode, everybody. Hope it helps out, gives you some insight. I'm going to go ahead now and I'm going to record on my Thinkorswim platform and share the mega cap names. I'm going to go through on Thinkorswim, and I'm just going to share those in the trade ideas tab in the Discord just to give an update because we've been seeing some volatility. Hope that helps. See you later.